Ever wonder why some investors seem to have a Midas touch, turning their investments into gold while others struggle to make a profit? Well, the secret might be simpler than you think. It's all about smart asset allocation. This is a key strategy used by successful investors worldwide, and it's not as complicated as it might sound. Imagine your portfolio as a pie. Instead of filling that pie with just one ingredient, say apple stocks, you would want a variety of flavors to ensure a balanced taste. That's what asset allocation is all about. It involves spreading your investments across various asset classes, such as equities, bonds, real estate, and cash, to balance risk and reward. It's not about picking individual stocks, but about choosing the right mix of asset classes. So, if you've been scratching your head, wondering how you can improve your investment game, you might want to consider smart asset allocation. So, what is smart asset allocation and how does it work? Let's break it down. When we talk about smart asset allocation, we're looking at three main pillars: diversification, rebalancing, and adjusting for risk tolerance. Firstly, diversification. This is like the old saying goes, don't put all your eggs in one basket. Diversification is all about spreading your investments across a range of asset classes. This could be stocks, bonds, real estate, or even cryptocurrencies. By doing this, you're not just relying on the success of one type of investment. If one area takes a hit, you have others to fall back on. It's a safety net for your portfolio, and it's a fundamental part of smart asset allocation. Next, we have rebalancing. Imagine you've set your portfolio with 50% stocks and 50% bonds. As time goes on, the value of these assets will change. You could end up with a portfolio that's 70% stocks and 30% bonds without even realizing it. That's where rebalancing comes in. It's about regularly reviewing your portfolio and adjusting it back to your desired mix. It's like a tune-up for your investments, making sure everything is running smoothly and in line with your goals. Finally, adjusting for risk tolerance. This is all about making sure your asset allocation aligns with your comfort level when it comes to risk. If the thought of losing money keeps you up at night, you might want a safer portfolio with more bonds than stocks. On the other hand, if you're comfortable with taking on more risk for the potential of higher returns, you might lean more towards stocks. It's about finding the right balance for you. Understanding these components is the first step in mastering smart asset allocation. Remember, investing isn't a one-size-fits-all approach. It's about finding the right strategy that aligns with your goals, your comfort with risk, and your financial situation. And that's what smart asset allocation is all about. Understanding these components is the first step in mastering smart asset allocation. Now that we know what smart asset allocation is, how do we put it into action? Well, it's all about following a few strategic steps. First, we need to identify our investment goals. Are we saving for retirement, a child's college education, or perhaps a new home? Each goal will have its own time horizon and will influence the type of assets we should invest in. Next, we must determine our risk tolerance. This is a personal decision, and it's about how much volatility or potential loss we're willing to accept in our investment portfolio. It's important to be honest with ourselves here. If the thought of losing money keeps you up at night, you might want to lean towards more conservative investments. Now we're ready to select an asset mix. This is where we decide what percentage of our portfolio will be allocated towards different asset classes like stocks, bonds, or real estate. This will largely depend on our investment goals and risk tolerance. For example, if we have a long-time horizon and a high-risk tolerance, we might want to allocate a larger percentage of our portfolio to stocks. The fourth step is implementing the portfolio. This is where the rubber meets the road. We actually purchase the assets in the proportions we've decided on. It's crucial to diversify within each asset class to spread the risk. In other words, don't put all your eggs in one basket. Finally, we must consistently rebalance the portfolio. Market movements can shift our asset allocation over time, so it's important to regularly adjust our portfolio back to our original asset mix. This helps maintain the level of risk we're comfortable with. By following these steps, you can implement a smart asset allocation strategy that suits your investment goals and risk tolerance. With consistency and discipline, you'll be well on your way to achieving your financial goals. Remember, investing is not a sprint, but a marathon. While asset allocation may seem straightforward, there are common pitfalls that can trip up even the most savvy investors. One of the most common mistakes is not diversifying enough. Investors often feel comfortable investing in what they know best, which might mean their portfolio is heavily skewed towards a particular asset class, industry, or geographic region. The problem with this approach is it exposes you to more risk. If that particular area experiences a downturn, your entire portfolio could suffer. To avoid this, ensure you spread your investments across different asset classes and sectors. Another common mistake is failing to rebalance your portfolio. Over time, the value of your investments will change, and this could throw off your original asset allocation. For instance, if your stocks do particularly well, they might start to take up a larger percentage of your portfolio. If left unchecked, this could lead to an overexposure to equities. The solution: regularly review and rebalance your portfolio to maintain your desired asset allocation. Another pitfall to avoid is not adjusting your asset allocation as your risk tolerance changes. Life isn't static, and neither should your investment strategy be. A 20-something just starting out in their career could afford to take on more risk than someone nearing retirement. As such, it's important to regularly reassess your risk tolerance and adjust your asset allocation accordingly. A final, yet crucial mistake is forgetting to factor in fees. High investment fees can eat into your returns and skew your asset allocation. When choosing your investments, be sure to consider the cost and how it will impact your overall strategy. Inadequate planning and lack of patience are other common missteps. Asset allocation isn't a set and forget strategy. It requires ongoing attention and discipline to stick to your plan, even when market conditions are volatile. By being aware of these common mistakes, you can ensure your asset allocation strategy remains on track. Remember, smart asset allocation is about balance and adjustment. It's an ongoing process that, when done correctly, can help you achieve your financial goals. So, there you have it, the basics of smart asset allocation. We've journeyed through the intriguing world of asset allocation, understanding its importance in balancing risk and reward. We've learned about the pillars of smart asset allocation, which include diversification, rebalancing, and staying true to your financial goals. We've walked through the steps to effective asset allocation, from determining your risk tolerance and investment horizon to selecting the right mix of assets. And we've highlighted common mistakes to avoid, like not rebalancing your portfolio or chasing market trends. Each of these elements plays a crucial role in a smart asset allocation strategy, helping you maximize your returns while minimizing risk. Remember, smart asset allocation is a powerful tool in your investment arsenal. Use it wisely, and you could see your investments grow. Don't forget to like, share, and subscribe for more investment insights. Thank you for joining us on this journey through the world of smart asset allocation. We hope you found this information useful and it helps you make smarter, more informed investment decisions. If you liked this video and want to see more like it, don't forget to give us a thumbs up. Sharing is caring. So if you think someone else could benefit from this video, don't hesitate to share it with them. And remember, the investment world is vast and ever-changing. So make sure you subscribe to our channel to stay up to date on the latest strategies, tips, and tricks for maximizing your investments. We appreciate each and every one of you in our investment community. Your likes, shares, and subscriptions help us to continue providing valuable content and insights into the world of investing. So, hit that like button, share the knowledge, and subscribe for more. In our upcoming videos, we'll delve deeper into other key aspects of investing, like portfolio diversification, investment risk management, and much more. So stay tuned and remember, smart investing starts with you.